Right, well, g'day there, everybody. Thanks a lot for joining me on this Thursday afternoon market recap. There is about 10 minutes left in today's session. I am going to go over, again, the technical update as these markets continue to push into these very short-term higher levels. But before I do so, I just wanted to say thank you very much, first of all, to the support and to the people who've been following this analysis for as long as you have. This YouTube channel, in fact, it goes back to 2012, 2013, that's when I began actually posting public YouTube addresses or updates when it comes to the application of technical analysis. And it's just really nice to receive positive comments or feedback as people understand how it is we interpret financial markets and what we're looking for during especially these somewhat hard and difficult times, understanding that it is relatively easy at this particular point to jump on board with this bullish continuation. I understand that. To a lot of people, they may not really understand or recognize anyway the amount of risk up and around these current levels based on what the market has done most recently in the second half of January, and also just given a fact that we have, or since we have broken out in the period of at least mid-October 2019. Very rarely in these circumstances will you see the market continue in a linear fashion. I'd say the overwhelming minority actually understand this, and unfortunately the majority are largely led by their emotions. This is a point in time whereby you don't want to be led by your emotions. Rather, you'd want to objectively look at this to really disconnect emotionally from the market and just recognize that although it may feel like an eternity, as you may be sitting down and just watching the markets from afar, or at least reading the headlines and seeing the market, say for instance today, up a further 0.2%, understanding that you're doing the right thing given of course the context and the amount of risk currently, right, sort of floating about in the US financial markets, but also in the global financial markets as well. I've spoken about this, right, over the past number of weeks. We've been talking about a potential double top on the overall markets, but really what's coming to light at this particular point, not only on the S&P 500, but also on the Dow Jones Industrial Average, the NASDAQ as well, more so included, is the fact that we're now beginning to establish that a very short-term bearish divergence, whereby we're seeing price action even through to, or very close to the close on Thursday, right, break above, pierce above temporarily that of the swing high back in the midpoint of January. But at the same time, the oscillating indicators, they're not really confirming this bullish move. I understand it was a very short, a very shallow pullback. This week has come as largely a surprise as to how obviously we closed out the week last week. But this right here, even if you wanted to look through the metrics of volume and public participation on this most recent bounce, there really isn't a whole lot of participation, or at least institutional participation in this most recent bullish bounce. It's really difficult for me to sit down, or let me rephrase this. It's very easy for me personally to sit down, look at the markets, to analyze the markets and do absolutely nothing, and to feel comfortable doing absolutely nothing. It's really hard to learn this. It takes a very long time, or at least it takes a lot of experience. And to actually be watching the markets for a number of years, I'd say probably more than 5 years, right? I mean, day after day after day, to really become content in disconnecting from the markets and realizing and simply understanding the amount of risk in certain situations, at certain locations, and during certain time periods. So for me, looking at this and really not doing a whole lot in 2020 when it comes to financially trading the markets, okay, for me, that's okay. And I'm perfectly happy accepting that as I sit down and even bring you this Thursday afternoon market recap, knowing that on a swing trade time frame, I've done absolutely nothing. What is difficult and what becomes challenging is when I sit down, obviously, put out these videos and essentially plead my case based on the analysis that this point in time just here is very dangerous, okay? People only really want to revisit most recent history. And if they look back again to the period of October, the market itself has been in a one-way direction. It's been a one-way sort of flow of traffic, and that, of course, is the higher prices. Let me remind you of a couple of things. For the entirety of 2019, we've been exceptionally bullish. The good news is that you can go back through the catalog and you can watch every single piece of analysis video that you want on this YouTube channel going all the way back to 2012, all right? You can tell also if you go back to Q4 prior to the turndown, we were very, very cautious on the overall structure of the market. The problem for many investors, not even investors, but traders, is that again, they get swept up in the emotion of the market, especially after the past 4 sessions, Monday through to the current close on Thursday. and they feel as though they're missing out. Again, it's that entire FOMO effect, which does psychologically completely weigh on them. And I understand it because I've personally been there when I was learning how to trade the financial markets many years ago. Now it becomes a lot easier for me. I understand the risk, and what I'm trying to do here through this public resource is just to share my understanding, my intuition, because I've sat through these types of events. I've sat through many of these very similar time periods, understanding generally what will happen if it doesn't happen in the next couple of sessions, but what will eventually happen at some very immediate point in the future. We've got so many red danger masks or danger signals all over this market, whether it's the bearish divergence, whether it's the naturally overbought, overextended setting of these markets since the breakout in October, whether it's the ADX turning down, if I can bring up the right template, the CCI now just pushing back above 100 again. But again, that's just a continuation of what has been this bullish trend. But there are so many signals, especially if you go out to the weekly time frame and understand just how overbought we are through the guise of these indicators here. All right, this situation, this scenario where we find ourselves, okay, in the period of February is very similar leading up to what was that intermediate time frame, or at least the intermediate swing high on the markets that held for pretty much a further 9 months into the future until we got into the midpoint of 2019 more recently, and then towards the back end of 2019 in the month of October, where we finally pushed above, right, the similar warnings that we're seeing at the moment over here at the current juncture. That is where I firmly believe we are. This is on a weekly time frame. You can see that the market continued for a number of weeks and everyone was celebrating, everyone was happy, everyone thought that this market was again going to infinity, that there was nothing negative, or at least price action. It was almost impossible for price action to pull on back down, but then it happened. And a lot of people got caught out, right, as they just continued to pile into, right, equities, options, whatever the investment vehicle was that they were choosing to trade, whereby, again, we got out early. I mean, these triggers, they haven't changed whatsoever. 2,852 was our target, right? It was the past swing high over here. The market itself, it continued for another 4 or 5 weeks, which was a further month, until ultimately everything we were speaking about played out. And again, I just wanted to say that again, I understand the psychological component, the aspect of trading financial markets, especially when you see, again, the market down to close last week, and you see this knee-jerk reaction to the upside after a lot of good news that has obviously come out this week, okay? But the chickens are going to come home to roost at some point. And what we're doing, and the whole premise of my analysis really moving into 2020, and here we are in the second month of 2020, has been we're still very much optimistic on the market. We're very bullish on the market for the entirety of 2020, as at this timestamp today, and nothing's changed from that. The reality is, though, we just want to buy this market, obviously, at better prices. And we really want to be buying this market when the majority, which at the moment is overwhelmingly bullish, okay, we're sort of in that sort of parabolic sort of state of the markets whereby everyone's just putting risk on. Instead, we want to be buying from these people who are under the pump when the market naturally moves back into that correctional state, that our technical indicators and the overall analysis really is leading us to believe that is ultimately coming. We want to be buying from people who are essentially being forced to sell, and we want to be buying at very, very significantly reduced prices, discounted prices, whereby, again, it starts to wane on the psyche or play on the psyche of people who then begin to believe that the end of the world is here, so to speak, or that the US or the global economy is moving into an immediate recession. That is not true. The markets are still holding up firm. However, there is going to come a point in time, right, in the near future, whereby we are going to see something like this play out. The difficulty for me is managing people's expectations, because I understand the expectations right now, obviously after the blockbuster 2019 that we had, is that they want to continue to sort of pull in those returns that they became accustomed to as we moved right up until the end of 2019. It was a tremendously profitable year. And naturally, it's human instinct or human nature to want to just replicate that straight out of the gate. The problem, again, is managing those expectations, really trying to massage the concept that markets do not move in a linear, right, straight line up. And it really looks to be the case since October. People are becoming accustomed to this, right at one of potentially the most dangerous turning points that we've already picked up on over here. Yes, the markets have pushed temporarily above it, but again, it doesn't discount or take away from the fact that all of the risk leading up into this turning point is now exacerbated after the low volume rise, okay? And also the contribution and the compounding effect of short-term bearish divergence across these oscillators, which really has me again sitting here personally feeling okay about doing nothing, but I understand it's the temptation effect of people who may not really intuitively understand this, who just simply want to back the track up and just begin purchasing equities at potentially, right, one of the most horrible locations and time periods retrospectively that's going to be, maybe up until the point whereby the markets do move into that ultimate parabolic blow-off phase. So again, we're not going to shy away from the analysis whatsoever. I'm still going to be sitting here providing you with this analysis, but I want you to understand that it has been a relatively difficult period, or at least a timestamp for me, as I sit down and bring you this free content on this YouTube channel. Because again, the easiest thing to do would be for me to sort of recklessly just say, yep, we observe all of these technical signals, but we're just going to throw them to the side and just be completely emotionally attached to this market moving higher. Very dangerous if you find yourself doing that. Very rarely does that work out. And you really want to disconnect your emotions whenever you enter into a position, and also whenever you leg out of a position. All right, it's very easy to be drunk on profits, okay? But at the same time, people do very silly things once they're under the pump, and when they begin to see a profit move against them as quickly as what I assume it's going to happen at some point in the very near future. So again, I just wanted to update you on that. The S&P, you can see here, markets are probably closed at the moment if I just actually update the current session data. If you have a look here anyway, the markets are closed now. The S&P 500 closed above where we were yesterday. People are celebrating. That's all well and good. Okay, but this, in my opinion, is exceptionally dangerous. Okay, we'll see whether or not I'm proven true, but more times than not, and I've seen this play out a lot, is that naturally you're going to see this effect play out. The Russell 2000 is still below that of its past resistance swing high at about 1,710. We'll observe this as well when you look at the transportational average. If I can look down on my screen and bring up the right chart, you can see again it's a long way away from 11,344, which again was a target on the upside after this breakout. We've spoken about the targets on the Russell 2000 in that pro class last weekend. That's meant to say RUT, my illustrative tool. It's sort of hot and cold every now and then. But again, don't get swept up in the mania. Very dangerous if you find yourself in the majority. You'd rather find yourself in the minority and cop the flack for doing so. And I feel as though, fair enough, fair game. It's an open platform here to do that. But again, all of this analysis that I provide you with, it comes from a good place. It comes from a place of honesty. And it's just my take on the markets, obviously what I'm doing, and obviously at the moment what I am not doing. And you've got the benefit of listening to me. And it's fine to disagree with me, but we'll see how all of this plays out. All right, so that'll do us as at this Thursday afternoon market recap. I'll see you all in that analysis class. Obviously, we'll see what the US unemployment rate does as at the open of trade on Friday. It's probably going to be a market mover. Again, that's holding in there pretty well. It's pretty stable at the moment after the previous print. There is still a lot of room between that and that smoothed moving average, right? One of those technical signals that we overlay with the fundamental macro sort of timestamp to understand where we are in the business and economic cycle as well. So again, we're still looking at a very optimistic 2020, but on the short term, okay, it's natural to see the market correct, and it's got all of the timestamps, all of the hallmarks for that to play out very, very soon, if it hasn't already done so really, through to this current juncture. So be aware, be warned. I'm not here to sort of scare anyone or to upset anyone, but this period in time can be a little bit difficult for people to really understand what's happening. I get that. I've been there personally many times before, but you'll get to a place eventually where you feel very comfortable doing absolutely nothing for the right reasons at the same time. Okay, so on that note, I'm going to say farewell to you. I look forward to going through this in great detail this coming Saturday. What I'll do, I'll actually map out the entire cycle as to where we are and really do my best to illustrate exactly what is happening at this particular time. All right, so on that note, everyone, I'm going to say farewell to you. Enjoy your Thursday evening. Enjoy your Friday as well. Keep your eyes posted closely to the US unemployment rate. And I'll see you in that Saturday class. All the best. Farewell.